And the problem becomes is it doesn't become a global phenomenon. Okay, it becomes a U.S. phenomenon. Okay, China and Russia are buying gold with both hands, as are most Eastern European countries, Middle East countries, Asian countries. All the central banks are buying record amounts of gold. So when the dollar loses its status as a reserve currency, it doesn't mean that the rest of the world is in deep shit.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions. Welcome back, Reluctant Preppers. We're delighted to have this first-time guest. It's a great honor for us. Nick Barisheff is an expert on precious metals. He's appeared on BNN, CBC, and CNBC. He's the president and CEO of Bullion Management Group, which purchases equal dollar amounts of gold, silver, and platinum bullion in an open-end mutual fund. Nick's also the author of $10,000 Gold, Why Gold's Inevitable Rise is the Investor's Safe Haven. Nick Barisheff, thank you for joining us this first time on Reluctant Preppers.
My pleasure. Good to be here.
It was a pleasure meeting you recently in person at a special event, and we're hoping that we can ask you for your perspectives. A lot of our viewers are quite concerned about the plight of their the financial situation and how many risks are present to their household finances and the well-beings of their family. They're often quite interested in precious metals such as gold and silver. And if you could talk to us about what your overview as an insider in the gold industry is, and I guess along the way, if you can tell us what you see currently happening for gold, and then we'd like to ask you some questions about why you started the gold fund that you did, and we also have some viewer-submitted questions to pose to you in the end. So if you could kick us off with what in the world is going on with gold, because it's being reported quite a bit more in the financial news these days.
Right. Well, there are plenty of reasons why gold is going up, but the main ones are that we hit a bottom in the fall of 2018, and that was 1,200, and we've been going up since. So this has been a slow rise since then. The issue when gold goes up historically has been when we've got negative real interest rates, and the issue is that's where you get the first thing. What is real inflation? So John Williams of Shadow Stats uses the old methodology of calculating it, and he's getting, depending on what year you use, 1980 or 1989, he's getting somewhere between 5 and 10% inflation. Another index called the Chapwood Index calculates inflation for a fixed basket of goods in the 50 major cities. Because obviously inflation rate is different, it depends on the city you live in. So he gets an average between the 50 major cities of about 10% a year. So the thing to understand that if you've got 10% inflation and 2% yields, you're losing 8%. And that's where one of the important characteristics of gold comes in, is the maintenance of purchasing power. And it maintains it whether it's in inflation or a deflation. There's studies have been done in both. And in fact, gold does better in a deflation because it loses less than everything else. So it makes it look like it's appreciating. But now we've got latest numbers I've heard was 13 trillion in negative yield bonds. So that's even worse than negative real interest rates. That's like a face value negative. So that's one of the primary factors. Now the thing that a lot of people, I'm made preparation and the issue of gold as a safe haven when the financial system collapses, but that ignores all the normal benefits of gold. So we've done considerable studies where gold at around 20% will reduce volatility and improve performance. So that's number one. If we look at gold in every currency in the world, the average appreciation since 2000 has been 10%. Most portfolios haven't done 10%. They're lucky if they get 5%. And Warren Buffett badmouths gold every time he's on CNBC, and he's considered the best investor in the world. But gold has in fact outperformed Berkshire Hathaway. For all the Warren Buffett back. So without looking at a disaster scenario, there's plenty of reasons to own gold on a normal day, and that's the main thing. It doesn't mean to say that you shouldn't prepare, because we buy house insurance, we buy car insurance, and we don't seem to have it in our minds to buy financial insurance. So by buying gold, you get the benefits of portfolio diversification and growth and so on, without having a financial disaster. Okay, you're still outperforming everything else just on a normal day. If the financial disaster happens, you've got built-in financial disaster insurance at the same time.
You mentioned, I wanted to follow up on one of the points you already discussed when you said about John Williams and his shadowstats.com revealing that we've been in a real negative interest rate position for quite some time with underreported official interest rates, with this false statistics versus the truth being. But that didn't just start in 2018. That's been going on for a long time.
Well, it's been going on a long time, but we've also been fighting the Fed's manipulation of everything. So if they didn't manipulate, then the true picture would have been seen in inflation, GDP, unemployment statistics. All those numbers are full of crap from the BIS, or not the BIS, the Bureau of Labor Statistics.
Okay. And so in your view, then, this more recent rise in gold out of its sort of a 6-year trading trough that it was in and breaking out should have legs if in fact it's kind of restoring what should be its natural response to these distorted difference in negative real interest rates?
Well, the other factor that where I came to the conclusion of $10,000 gold in my book is that up until 2012, U.S. debt and gold were totally correlated, and they diverged in 2012. The U.S. debt kept going up, gold went down. Now it's getting back on track, but it needs to get back on track to correlate again, because that's the driving factor. And right now, if it was to get back to the correlation, it would be about 2,200, like right at the moment. So that's the catch-up. Silver and platinum are grossly undervalued relative to gold. Silver's at 80 to 1, and the average is about 40 to 1, and it's 16 to 1 in terms of how much of the metal in the earth. And platinum is usually a couple of $100 higher than gold, and it's about $600 lower than gold right now.
In your view, as people look at the dynamics of what's driving the gold action and the price action over the past year here, do you expect that people should see that that's going to be continuing for the rest of this year and beyond?
Well, I think so. I think that if at some point in time the central banks of the world lose control and they can't simply print more money, because the balancing act there is at some point you get into inflation and then hyperinflation. So they're going to keep the lid on giving you the real numbers for a while. That will keep everything at bay. If you listen to CNBC, they'll tell you it's 2%. You know, anybody that shops or sends their kids to school or pays for health care knows it's not 2%. You know, so that's the thing. And John Williams on his site, he points out that the old methodology had a fixed basket of goods.
Right.
So steak was steak, and so now what they do is, one of the measures is they replace the steak. When people can't afford steak anymore, they put in hamburger, and they say, well, magically no inflation. You know, so the whole thing is distorted that way, but constantly adjusting the basket of goods. But what does that mean? You can't afford steak, then it's hamburger, then it's dog food? You know, that's the reality of that kind of, you know, nonsensical theory.
You also mentioned when I saw you in person that that goes as well for like consumer goods, electronics, and so on as well.
That's right, but the big number is real estate. Real estate makes up 40% of the CPI, and one would think, well, the real estate component in the CPI would be how much it costs to buy and mortgage a house, or how much it costs to rent a house. Well, it's nothing like that. What they do is they take the global amount of houses and come up with a kind of cost base on the total, and then when a few sell this year, that's the inflation rate. And that's got nothing to do with nothing, but that makes up 40% of the CPI.
Could you tell us a little bit more about the gold fund that you started, or the precious metals fund that you started, why you felt it was important to do so, why it was novel, and what kind of response you've gotten to it? In Canada at the time, there was no way to hold bullion in a retirement fund, in an RSP. So I wanted to set up a fund that didn't compromise the attributes of bullion. I could have done a closed-end fund that the stock trades, you know, on an exchange in about 3 or 4 months. It took 4 years to do it this way, because on an open-end fund, you purchase and redeem in and out of the markets. So it's not a question of the amount that's traded every day. It just goes back to buying and selling bullion. We have a fixed investment policy where we don't lease, we don't hedge, we don't rebalance, we don't mess with the gold. And we have a fixed investment policy, so you're not depending on the skills of anyone for your gold performance. You just buy the gold, you leave it alone. And like I say, if you've done that over the last 10 years, your average return would have been 10%. 10% a year. Okay, so all this messing around with stocks and bonds and so on is not really necessary or worthwhile. And the nature of this fund, the fact that it actually does hold precious metals is one thing, but also that you say that it made it eligible for retirees or people who want to save for their retirement to be able to be able to invest that in precious metals.
Now this is in Canada, and the reason it took 4 years to get this done was we ended up getting 6 exemptions from the Ontario Securities Commission. So with every exemption, you had to give them a whole proposal as to why this is in the public interest. So this went back and forth for 4 years. So they finally approved it, and then a few years later, they approved a gold-only fund and a silver-only fund. So now we have all three. And we also sell individual bullion bars to high net worth clients, where they can buy it and store it with rigs in Toronto, Montreal, Calgary, Vancouver, Hong Kong, Singapore, Dubai, Geneva, and Panama. You choose which Brinks vault you want them in. So we're doing both ends. One is for the retirement account, and the other one is for high net worth
Are there similar funds available for U.S. investors?
No, because in the U.S., unless you do a closed-end fund that trades on an exchange, you couldn't get the exemptions that we got in Canada in the U.S. We investigated that, and it couldn't be done.
Interesting.
Like one of the exemptions was in a mutual fund in both Canada and the U.S. They don't allow you to have more than 10% in any one asset class. So in our first fund, we had 33% in each of gold, silver, and platinum. But then later, we were able to persuade them to let us have 100% in gold and silver. But in the States, they wouldn't give you that exemption.
Huh.
That puts you dead in the water right there.
Interesting. Well, if we could turn our attention now to some questions that have been submitted by viewers, and see what your perspectives are on these. People are aware that you have a long experience history in the precious metals investing industry, and they have questions related to that. I'll clarify right off the bat, people have heard this before from me, that we are not a financial advice giving channel, and our guests are not here as your financial advisor, but we're getting your perspectives and your insight, and it's educational for our viewers, and we appreciate that. So Gary E. Worrell says, what major factors make you so confident that gold prices may soar to $10,000 per ounce?
Well, like I say, the premise of the book was the relationship between the price of gold and U.S. debt, them being totally correlated. And once the Fed stops intervening and manipulating, it should get back to that same relationship. And that's simply because the U.S. dollar is the world's reserve currency. So, and gold is kind of the anti-dollar. So as the dollar depreciates, gold goes up. It's that method. And every dollar in existence has been borrowed into existence. So it's just an IOU. It's nothing worthwhile, that's all. So that relationship, they haven't handled the budget deficit. It only gets worse and worse every year, and I don't see any reason it's going to slow down or stop.
In fact, the rate has been accelerating in an exponential manner. And they said that during the Obama administration, they were faulting him for racking up more additional debt than all the presidents before him combined, and now Trump is well on the record that same track as well.
So it's not something that when you analyze fiat currency, is the bottom line is there has never been a fiat currency that didn't end up in hyperinflation. There's been 57 hyperinflations in the last couple hundred years. 57, not just Germany and Zimbabwe, 57. And every time what happens is the politicians feed everybody the same bullshit, that elect me and I'm going to give you all this free stuff. Well, either you're going to borrow the money, tax it, or print it. So the easiest thing for them to do is print it, and then eventually the currency becomes worthless.
The next question we have is from SG Fans, who says, what is Nick Barisheff personally doing to prepare himself for a coming dollar crisis?
Well, see, when you look at a crisis situation, you got to look at to what degree is the crisis going to be. If we have an EMP attack, whether it's a bomb or natural, then you're screwed anyways. Okay, everything goes out to be very difficult to survive in an EMP situation in North America. But there's other levels of that. So if we work backwards and say, okay, what are the levels? Well, the first level is we can have a simple software breakdown at the banks. It happened in Australia, where the software that handled the administration broke down, and half the banks were affected. They were shut down for 2 weeks. So 2 weeks, you didn't know how much was in your account. Credit cards didn't work, debit cards didn't work, all that. So at that point, you don't need gold and silver, you need physical currency, because it may be a few weeks or a month, but even then a few weeks would having no ability to buy gas or food wouldn't be pleasant. You could have a multi-million-dollar stock portfolio, but no cash. So you've got to start off with physical currency in your possession. A month, 2 months, something like that. The next stage of it is when there's a loss of faith in the currency. So like if you think of Argentina in the late 90s, that kind of situation. So in that kind of situation, the paper currency becomes worthless, and that's where you need your gold and silver. But gold at that point, like say it becomes at 10,000 an ounce, it's hard to go grocery shopping with one gold coin. So that's where silver comes in, even junk silver, because by then it'll be known what the stuff is worth. Right now, if you went to the grocery store with an ounce of gold, they wouldn't know what it was or how much it was worth.
I have to interject because I remember vividly during my high school years, which I graduated in around 1980, and I remember coming home every day in the newspaper. There was a full page ad from this outfit that was buying your silver coins off you, and it was at the top, 10 times face value, 12 times face value, 18 times 20 times face value as the days went by that they were willing to pay. So everybody was kind of watching this, and people, you're right, in that kind of a situation when it's in the public's mind share, then it's at the tip of everyone.
When that happened, there was a secondary aspect of it, and that is that the mints couldn't keep up to production. That's why they were getting premiums on bullion coins, because there was a shortage. They just couldn't keep up the production. So that's a different factor in and of itself when the demand gets to be that high. In Toronto, the Bank of Nova Scotia is the biggest bullion dealer in Canada, and in the late 70s, like one of our directors started working in the precious metals division in the late 70s, and the first thing he had to do in the morning was go out in the street and count the number of people that were in line, and when he got to a certain point of the lineup, he had to tell the rest they might as well go home because they won't get served today.
That's remarkable. Yeah, I just visiting a local coin shop, because I talked to my viewers about that. We do most of our bullion purchases online, but I've started frequenting a local coin shop for private transactions, and they are telling me that, again, even in the 2011 run-up in silver and gold, that there were, before the shop would open in the morning, there was lines down the sidewalk, around the corner, and on, and they'd have to hand out numbers to everybody so that there wouldn't be any pushing and shoving, and everybody would take their turn. They'd be out there all day standing in line to try to get in there and make their transaction.
So the problem with buying bullion from a coin dealer, which is something I've thought of on a personal basis, is the fact that when this happened in Argentina, so that the peso dollar accounts became worthless, they converted the US dollar accounts to peso accounts, so they became worthless. So then the people that had precious metals could go to the coin dealer, so they'd go to the coin dealer and sell some coins and then get robbed on the way home. So that's the problem, that one thing, you have a financial collapse, but then you have a lot of hungry people and everything else where you've got that. So in our case, where we sell the physical bullion to people that are stored at Brinks, it's just a phone call. We have everything documented. So you call me and say, okay, I want to sell $10,000 worth of gold. We wire you the money. Or you can pick it up at Brinks and take it home at any time or anything like that. But you don't have to. And that's the main thing. People don't consider what the world would be like at $10,000 an ounce gold. Not a fun place.
Right. In fact, that's another question from Slick Willie, who asks, Nick, seeing the whole world would be in a full meltdown if gold soars to 5K, 10K, or above, do you think the powers that be will impose huge taxes on profits or just confiscate all gold?
Well, a lot of people ask me that question at Rob Kirby's event, And the thing is that there's a great deal of confusion. The gold was never confiscated in the U.S. It was expropriated. The market price of gold at the time was $20 an ounce, and they paid you $20 an ounce when you turned it in. That means today they would have to pay you $1,500 an ounce. Okay, so it was never confiscated by anybody. Canada was never confiscated or expropriated. Okay, but in 1933, when it was expropriated, gold was money. They needed to do that because they couldn't just print as much money as they wanted. They were still on a gold-backed standard in 33. They cut that off, and then in 71 cut off that even foreign countries couldn't exchange dollars for gold. But up in that whole point in time, up until 71, from 33 to 71, gold was fixed price at $35 an ounce. It was money. So right now, if you confiscated all the coins and all the privately held gold in the United States, that would be about a couple of days of budget deficit. Not worth it. And the problem is it doesn't become a global phenomenon. Okay, it becomes a U.S. phenomenon. Okay, China and Russia are buying gold with both hands, as are most Eastern European countries, Middle East countries, Asian countries. All the central banks are buying record amounts of gold. So when the dollar loses its status as a reserve currency, it doesn't mean that the rest of the world is in deep shit.
In such an outcome, where does that strategically place the U.S.? Because you mentioned a little while ago about the U.S. dollar being the world reserve currency. What is coming then if all these other countries, not the U.S., are accumulating physical gold and the U.S. is not? Where does that leave us strategically?
Well, there could. Well, in terms of people holding U.S. dollars, it would be in a lot of trouble because it's everything based on the U.S. dollars, the stocks, bonds, treasury bills, everything would get devalued rapidly. One of the proposals is to have the IMF create a basket of currencies. The second thing is China's looking at doing a gold-backed Chinese yuan, that kind of thing. So the way that goes could change things.
We have another question from Davina Marshall, who asks, I remember the gold mania of the late 1970s. I didn't have money to be a player, so all I could do was observe it, and it was unbelievable how some penny stock would run from 10 or 20 cents to $10 or $20 on nothing more than a press release that the company had acquired a few mining claims with gold showing. Do you expect we could have a repeat of that? So mining stocks.
Well, quite possibly. There's two things about mining stocks. One is that just like in the internet bubble in 1999, we could have the same thing happen with mining stocks. And she's right. Anything called something with gold in it could be going up in value, just like we had a lot of .com stocks that were totally worthless and so on. So you're going to have the same thing. The thing to understand with mining stocks is that normally they're correlated to gold. So the gold price goes up, the mining stock goes up. Except in the case in a broad equity market decline. When an equity market takes a broad decline, like 2008, the mining stocks tank by more than the equities because they're so thinly traded. Okay? And then once people catch their breath, then they catch up to gold. But initially, and that's why we don't use mining stocks for portfolio performance. It makes the portfolio worse, not better. They're purely for speculation. So if you know what you're doing and you know which junior mining company to buy, fine. The opportunity is to buy it at the bottom of an equity decline. Like in 2008, equities declined by 40%, and mining stocks declined by more, and gold was up 26%.
Interesting.
In 1987, Barrick was no bid for 3 days. When we had the 87 crash, no bid for 3 days on the world's biggest gold mining company. So by all means, for a portion of your portfolio that you're going to allocate to speculation, that's mining stocks, but it's not the same as gold bullion.
For sure. We have 3 questions that are all along a similar vein here. Another one by Davina Marshall and 2 by Marcosius Rex. Let's just start with this one. In 2008, they implemented QE multiple times, which, quote, saved us. No one saw that coming, even the gold sellers. In the event there's another similar event, it's entirely possible that those in the government have fail-safe plans that will be initiated to, quote, save us again. Plunge protection specialists, blah, blah, blah. Isn't it possible that they can save the system again?
What I have to stop you there is that they didn't save us. They've kicked the can down the road.
Right.
Now we've got a much bigger problem. The first time, I've been in the business for 40 years. This is the first time where we have a simultaneous triple bubble in stocks, bonds, and real estate. Simultaneous. Normally they happen in sequence, not at the same time. So in this next market crash, whether it's caused by real estate or stocks or bonds or whatever, when it happens, it'll trigger the other two. And then you're going to have a crash of monumental proportions. A lot of people that are financial observers think that it'll be worse than 2008, and many think it'll be worse than 29.
Mm-hmm. So the question is, and this is again echoed by Davina Marshall, are we now at the stage where the only real option left for central banksters is massive currency printing leading to hyperinflation, or could they have some other cards to play?
Well, I've read a lot of opinions on it, and I think the issue of printing money and lowering interest rates are their only 2 tools. Well, they're at the bottom as far as interest rates, so the only thing left would be like quantitative easing and printing money to buy stuff with, even in Switzerland, the central bank is the biggest equity investor in Swiss stocks.
Mm-hmm.
Yeah.
If you'd like to watch an extended bonus version of this interview with some additional questions for Nick, come and join us at patreon.com/reluctantpreppers, and becoming a supporter, you get extra access to this extended version of this and future episodes as well. Thanks. Nick, before we let you go, I wanted to mention that when I saw you in person, you handed me a audio CD. My wife and I listened to it all the way back from Toronto to where we live in the Midwest, and it was extensively detailed about the history of money and about many of the dynamics and aspects of the financial world that we are not typically taught anywhere else. Could you talk to people about how they can get their hands on your book, $10,000 Gold?
Well, the books are available on Amazon and all that, but we have digital versions in Kindle and the Apple version, and then we also have the audio CD version. So all those available. Then the information's on our website, and we also do a weekly newsletter called the Bullion Buzz. People can subscribe for it, and I pick about 6 good articles a week to summarize in there. So that keeps people with an alternative view than what they see in the mainstream media.
We really appreciate that, because our tagline here on Reluctant Preppers is helping you be aware and prepared, and that awareness from someone with true insider knowledge in the industry is extremely helpful.
Well, being aware is a starting point, because then you have to get it to prepare, and that's where the starting point is.
We've been speaking with Nick Barisheff. He's the CEO and president of BMG for this first time on Reluctant Preppers. Nick, really appreciate you joining us here and for sharing your experienced wisdom with all of our viewers.
My pleasure.
If you'd like to watch an extended bonus version of this interview with some additional questions for Nick, come and join us at patreon.com/reluctantpreppers, and becoming a supporter, you get extra access to this extended version of this and future episodes as well. Thanks. Hey, Reluctant Preppers. If you haven't heard, we've already started our monthly 1-ounce U.S. Silver Eagle thank you gift to one active Patreon subscriber each month, signed by your host, Dunnigan Kaiser. And you don't want to miss out on that.
Please help us grow by subscribing today at patreon.com/reluctantpreppers.